Good morning. It's Friday, the 18th of October, and this is Govindraj Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's financial capital. The Take. Was the Hyundai IPO a flop show? By present standards of retail investor dynamics, Hyundai Motors' mega 28,000 crore initial public offer was pretty much a flop. The retail investor part is important because while the issue as a whole was oversubscribed about 2.4 times and thus sailed through, it was thanks to institutional investors who flexed their muscles. Importantly, the retail section was only 50% subscribed, while the non-institutional investor segment was about 60% subscribed. It would be safe to say that looking at the overall auto market conditions right now, where cars are not exactly flying off showroom shelves, and the flattish mood in the stock markets, the Hyundai stock will either list flat or drop at listing. Actually, it would be a near miracle if it starts climbing after listing, at least in the short term. And there's a reason why I'm talking about the short term, and I'll come to that in a moment. There was some trepidation around this listing, largely for sentiment reasons. First, let's look at the fundamental side. The financials were seen as strong, the track record sound, and the clear recognition that this was a strong number 2 player in the Indian passenger vehicle market, battling it out with the number 1, so the Koreans versus the Japanese Maruti Suzuki. But when it comes to segment, big IPOs are usually a sign of a market peaking out, even if there is no direct correlation. And the bigger factor is the perception here of listing gains. As the Securities and Exchange Board of India study said last month, 54% of IPO shares in value terms were sold within a week by non-anchor investors. This study was based on data from 144 main board IPOs, that is the non-SME ones or non-small and medium enterprise ones, between April 21 and December 23. Suffice to say, or quite likely, that trend hasn't changed after that. If at all, it could have only got worse. Moreover, individual investors sold almost 68% of shares by value allotted to them within a week when returns were more than 20% and sold about 23% shares by value when returns were negative, the study said. So you can see that when they lose money, they're still selling because they don't have the patience to wait or they never intended to wait, and it was always a punt on the short term. So it's clear that most investors who punt on IPOs are comfortable placing their bets in the sub 400 rupees per share, that is. Now that's a guess, but it's a pretty educated guess. This also applies to some extent to the secondary market, as I've been told by many market veterans, and that's one reason why small caps and mid caps have seen such huge flare-ups in their values in the last few years. So a price of about 1,960 per share or thereabouts is a deterrent to most such investors who may not be willing to cobble together funds if they don't see or perceive a listing pop, and more likely would not even venture to buy such a high-priced offer. Not surprisingly, they gave it a pass. Possibly, Hyundai could have priced the offer lower, though possibly again, that would have gone against the advice of its investment bankers if that were the case. In Hyundai's mind, the competition is with Maruti Suzuki, the number 1 player, and thus, I guess it priced its stock aggressively. Hyundai's cars have always been well priced for value-conscious Indian customers, starting from its Santro in 1998, which also explains the Korean giant's success in the Indian market. Possibly Hyundai forgot to take a leaf from its own book when it came to pricing this IPO. And the top stories and themes for the day: the stock markets lose further ground. The European Central Bank cuts rates for the third time. The Hyundai IPO scrapes through. The Reserve Bank of India cracks down on more non-bank finance companies, including leading app-based ones. And high prices are slowing down festival sales.
This is a core report with Govindraj Ethiraj.
Indian markets slide further. The stock market sank further on Thursday as few triggers, if any, except for maybe some bright spots on the IT horizon in the form of better than expected results from companies like Wipro, which unveiled a 21% increase in net profits to 3,209 crores. Wipro also announced a 1:1 bonus share issue even as its consolidated revenue fell about 1% year on year. Elsewhere, Bajaj Auto stocks fell 12% on Thursday after it said it anticipated weak festival season sales, and more on that shortly. That warning affected other automaker stocks too and dragged the overall market on Thursday. Bajaj Auto, which is also India's third largest motorcycle maker by sales, said that festival sales of motorcycles had grown only about 1 to 2% so far this month, falling short of market expectations of 5 to 6%, according to Reuters. Now that, in the case of Bajaj Auto, would compute a sales growth of about 3 to 5% in the festival season that runs from October to November, and that's below industry expectations of at least 8%. The benchmark indices, the BSE Sensex and the NSE Nifty50 ended in the red, and that also kept pace with Asian stock markets. The BSE Sensex fell about 495 points to end at 81,006, while the NSE Nifty50 ended at about 24,750, down 221 points. The broader indices were also lower this time, with both the Nifty Midcap 100 and the Nifty Smallcap 100 indices going down about 1%. Amongst the sectoral indices, just one did well. That was the Nifty IT index, which was up slightly. So the India-China sweepstakes are not looking very good for India, that is. Most major brokerages, as we've reported, have upped China weightages. These include Morgan Stanley, Bank of America Securities, Jefferies and Macquarie, among others. 17% of global investors surveyed by Bank of America said long gold was the most crowded trade, followed by long China equities at 14%. This survey happened last week. And back home, Elara Securities fund level analysis in October showed a total shortage of about $32 billion, or about 3.5% of assets under management, with the top 450 global emerging market funds. So at 20% weight, Elara said this could still lead to a $6 billion selling in Indian equities. Remember, we've already seen about $7 billion or more this month by foreign portfolio investors. Now, the interesting thing is that Wall Street is hitting fresh highs, but the sentiment there is not really heading eastwards like before for the reasons we've discussed. Stocks were strong on Thursday after the Dow Jones Industrial Average rose to a record close on Wednesday. The big news on Wall Street was Morgan Stanley, which rose 6.5% after topping Wall Street estimates for both its third quarter earnings and revenue. United Airlines also reported better than expected results and forecast strong numbers for the fourth quarter, sending shares about 12.5%, CNBC reported. So all of this obviously indicates that non-tech shares on Wall Street are gaining strength, including banks, something we mentioned earlier in passing too. And the Hyundai story, just to wrap it up, its mega 28,000 crore IPO was oversubscribed by more than 2 times on Thursday, attracting aggressive bidding from institutional investors. This was its first listing outside South Korea and is India's largest and the world's second largest IPO of 2024, according to Reuters. The European Central Bank lowers rates. The ECB, or the European Central Bank, has lowered interest rates for the third time this year, thanks to a hastier retreat in inflation, which allows it to offer support to the region's slowing economy, according to Bloomberg. The key deposit rate was cut by a quarter point to 3.25%, as predicted by analysts in a Bloomberg survey. While this looked unlikely just 5 weeks ago, it does follow a slump in inflation to below 2% for the first time since 2021, alongside softer private sector activity and cracks in the so far resilient jobs market, according to Bloomberg. The European Central Bank President Christine Lagarde reiterated that risks to growth remain tilted to the downside, but she said a recession was not likely and added that they were still looking at a soft landing when speaking in Slovenia. The Reserve Bank of India asks more NBFCs to stop lending. The Reserve Bank of India has cracked down on a fresh set of NBFCs, or non-bank finance companies, on multiple counts for what seems like a fairly brazen set of violations. At least 2, as I could see, are app-based companies. Asirvad Microfinance, Arohan Financial Services, DMI Finance and Navi FinServe are the NBFCs that have been asked by Reserve Bank to cease and desist from sanction and dispersal of loans with effect from close of business on the 21st. The Reserve Bank says the action is based on material supervisory concerns observed in the pricing policy of these companies in terms of their weighted average lending rate and the interest rate spread charged over the cost of funds, which are found to be excessive and not in adherence with the regulations. The Reserve Bank said that these were also found to be not in conformity with provisions laid down under the Fair Practices Code. Unfair and usurious practices continued to be seen during the course of on-site examinations as well as data collected and analyzed off-site. The Reserve Bank said that these NBFCs were variously found to be in non-adherence with the regulatory guidelines on assessment of household income and consideration of existing proposed monthly repayment obligations in respect of their microfinance loans. Deviations were also observed in respect of income recognition norms, resulting in evergreening of loans, conduct of gold loan portfolio, mandated disclosure requirements on interest and fees, outsourcing of core financial services. The core in the past has argued for greater focus on fintech-led lending, since this is where most of these infractions appear to take place, given the fact that there is excessive funding and perhaps very little regard for regulation. Slowing down would also allow more time for greater due diligence and better monitoring, since it's quite evident that the intent to do so at least in part of some of these NBFCs, is somewhere between weak to non-existent. The Samsung strike ends. Workers at Samsung Electronics Indian unit have decided to end the strike at its factory in Tamil Nadu, the company said on Tuesday, which brought to an end a labor protest that continued for more than a month, Reuters reported, adding that the strike backed by the Center for Indian Trade Unions was the biggest such dispute in recent years in India and cast a shadow on the government's effort to set up local manufacturing, particularly in electronics, and that's why that strike was important. Samsung India, in a statement late on Tuesday, said it welcomed the decision by C2 to call off that strike, which employs about 1,800 workers and makes refrigerators, television sets, and washing machines. Samsung said that they would not take action against workers who merely participated in the strike. Where is India's consumption going? So the signals are mixed so far. Rising prices of edible oils and vegetables like onions and tomatoes have driven up grocery spending for Indian households ahead of the festival season, prompting consumers to limit more expensive purchases like electronic items, according to retailers who spoke to Reuters. Now, this, of course, syncs with the latest consumer price inflation numbers, which hit a 9-month high of 5.5% last month. Food inflation was at 9.2%, and vegetable prices were 36% higher than a year ago. India's annual festival season runs from late September to early November, which is into Diwali, and sees amped up buying by households for food and other goods, also, of course, increasingly driven by discounts both offline and online. Not so much this time. Sales of electronics and home appliances so far in October have risen just 5 to 7% from last year against estimates for an 8 to 10% jump. Nilesh Gupta at Vijay Sales, a retail chain with about 143 stores, told Reuters, though he said that he was still optimistic that sales would pick up. But other indicators like auto sales and the Manufacturing Purchasing Managers Index, PMI, are also weak, as we've been pointing out. Remember that we've been referring to the buildup of inventory at auto dealerships. Online sales, which account for about 15% of retail sales during the festive seasons, are also off to a slow start, said Reuters, quoting CRISIL Market Intelligence and Analytics, saying there are signs of continued income stress on low-income groups. So how is it looking at the store level? I reached out to Vishesh Dora, who leads the data insights practice at Bizom, which tracks about 300,000 distributors and 8 million corner or kirana stores, about how stocking levels were looking and what was pricing or how was pricing playing out.
I think as Bizom, what we look at is how is stocking looking at this point, because we largely work with all stocking points in the FMCG industry. So I'm going to answer that from a stocking point. I think JAS as a quarter was expected to be at 12% growth. We are seeing a little higher than that. That means stocks are in. Festive season has started. Couple of things that clearly are standing out is that commodity is one thing where stocking is better than last year. That means India is preparing for sweets. Last year, the post-festival analysis or the total sales that we looked at was somewhere around 4%, right? With major contributors coming in from chocolate and dairy. Right? This year, JS in itself is more than 12% is what we are seeing right now. July, August, September of this year. Last year, it was mid-November, right? So this time it's a little ahead. So stocking has happened largely and it continues to happen if I look at this 15 days as well. Largely value-wise growth. If I talk about value of stock available, chocolates, confectioneries and dairies are three places which have seen huge uptake. Partly pricing, partly demand. When I say partly pricing, all of us know chocolate, cocoa prices are going through the roof. Dairy, while in the beginning of the year it wasn't growing that much from a price standpoint, it has gone up again. So chocolates have grown by 10 to 15%, dairy again 15% up, right? Which means festive spendings are going to get a little expensive, especially if you're looking at gifting, sweet consumption as well. So those are largely what we are seeing today. From a stocking point of view, we see the large retail points being overstocked or amply stocked to meet consumer demand.
Right. So that's the festive part, right? Which is why I'm assuming you're talking about chocolates and confectionery and dairy. What about the non-festive part? How are trends looking there?
Largely, when we look at categories, we look at 4 or 5 block categories, right? So you have beverages, chocolate confectioneries, you have commodities, you have dairy, home care, packaged food, and personal care, right? Thankfully, all of them have grown in this quarter, right? Beverage is the least. right, which has grown, largely understandable because change in season, change in priority for consumers. If I look at personal care, again, from a pan-India level, we're seeing roughly around 14% growth in the quarter. What is seeing some flat trajectory or very less growth is home care, largely 3%, right? So those are what other categories are looking like, apart from the festive-driven categories. Things like commodity, where we are seeing some festive effect, largely grow at around 25% in the quarter.
So how would you compare this? I mean, is there a way of looking at a quantum over 2 or 3 years? Sometimes these monthly figures can be a little misleading. So is there a longer trend line?
Yeah. So I'm talking about the year-on-year comparison, which is last July to September quarter versus this July to September quarter, right? So that gives us a like-to-like comparison of where we were last year. So last year, whatever commodities we had stocked up on in the market, right now we are up by 25% on that.
So that seems like a huge jump, isn't it?
Yeah. I mean, prices have gone up. Largely, if you look at value sales, 7-8% prices have gone up. And even if you take 4% as consumption increase, you can attribute rest to festive stocks.
So if you were to now equalize between festive and non-festive, how would you consumers are behaving at this point of time in this year?
So I'm going to add one more layer to that, because can't put consumers into one basket with how it is today, right? So how we've been sort of studying consumption in India for the last 2 years at least is look at it from an urban and a rural standpoint, right? So urban consumption is not that great, and we've been reading about it for over the past couple of months, right? And that's visible. So your major consumption or major growth driver is the semi-urban and the rural India today, like largely great direct penetration, right? No Q-com effect, no e-com effect, right? That is what we are seeing, where the contribution to growth across has been higher in the rural, especially in things like personal care. As if I look at last year versus this year, just the mere penetration, which is the number of outlets where branded products are increasing in personal care, has gone up by 40%. Right? Dairy, which is huge, right? Everybody in rural would look at making ghee at home or buying an unbranded item, is gone up by 27 to 28%. And these are just improving the penetration of branded commodities in rural. So rural is definitely growing in terms of their spending in India. From an urban point of view, packaged food remains around 3 to 4% is what we're looking at right now. Right? From other category, personal care around 14% again. Right? So urban, the growth is pretty static, if I may call it so. But rural and semi-urban is where direct distribution muscle is being built, penetration is improving, right? And therefore, we are seeing effect of brands making it big enough in semi-urban. And
Right, Vishesh, thank you so much for joining me.
thank you so much.
And before we go, some feedback which we've not been carrying for a few weeks. An anonymous listener tells us that he enjoys the style and delivery, would like us to go into a bit of detail, like, for example, why is Chinese steel cheaper than Indian steel? Is it only due to dumping, or is the cost of manufacturing cheaper? Well, that's a very good question. Some of it is linked to the fact that the Chinese have huge amount of capacity and domestic demand that's in China has slowed down, but we will get you more insights from people who know better. Manoj Jha says, excellent capsules on news and events. Please do cover a particular industry segment in detail. For example, the acquisition of Hubeck by Sudarshan. And that's a request that we've been getting from quite a few people, that we should cover particular industry segments in detail, and we will definitely do that. And Mohammed Murtuza says, excellent presentation, very objective. Well, that's it from me then. Thank you very much for listening. Do send us your feedback, and we are incorporating all of this into our programming as much as we can, and do hope to keep getting more of this in coming days. Thanks very much. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.